Welcome to Futures Trading 101. In this class, we will explore the world of futures trading, a strategy that involves buying or selling contracts to buy or sell an asset at a predetermined price on a future date. My name is Metamat, Director of Education over at PB Stock Alerts, and welcome to PB Trading University Light Class 45. So, what are futures contracts? They are agreements between two parties, a buyer and a seller, to buy or sell an asset at a predetermined price on a future date. The underlying asset can be anything from commodities like gold, oil, and wheat to stock indices, currencies, and even interest rates. Imagine you are a farmer and you have just harvested wheat. You are worried about the price of wheat falling before you can sell it. You can enter into a futures contract to sell wheat at a fixed price in 6 months. This would lock in the price you receive for your wheat, regardless of what happens to the market price in the meantime. Before we delve deeper into futures trading, let's familiarize ourselves with some essential terms. Underlying asset, the asset that is being traded, such as gold, oil, or wheat. Futures contract, the legal agreement between the buyer and seller, specifying the underlying asset, quantity, delivery date, and price. Delivery date, the date on which the underlying asset is due to be delivered or cash settled. Contract price, the predetermined price at which the underlying asset will be bought or sold on the delivery date. Tick size, the smallest price increment by which the futures contract can change. Margin, the deposit required by both buyers and sellers to ensure fulfillment of the contract. Futures contracts can be categorized based on the underlying asset. Commodity futures are contracts based on commodities like gold, oil, and wheat. Equity futures are contracts based on stock indices or individual stocks. Index futures are contracts based on broad market indices like the S&P 500. Currency futures are contracts based on foreign exchange rates. Interest rate futures are contracts based on interest rates. Futures trading offers several potential benefits, including hedging, which is protecting against potential losses in the underlying asset's price. Speculation is profiting from anticipated price movements in the underlying asset. Diversification is another benefit as it expands your investments beyond traditional stocks and bonds. However, futures trading also carries significant risks. The use of margin can magnify gains and losses. Futures prices can fluctuate rapidly due to market factors, and there is the risk of the other party in the contract failing to fulfill their obligations, which is not a concern when it comes to trading via online brokers. Futures trading is a complex and sophisticated investment strategy that can be both rewarding and risky. It is essential to understand the underlying concepts, risks, and potential benefits before engaging in futures trading. Follow for more educational content. I hope to see you next class, but until then, I hope that you all make some bread.